Very quickly now, let's turn our attention to how markets have been performing across today, particularly if we start our attention out in Asia. One would have hoped that things would continue on a positive trajectory, considering where we have been for quite some time now. Things have gotten better because economies have begun opening, and that was the hope, that things would continue to open and we'd continue to get a sense then of markets perhaps adding up some positivity as well. But unfortunately, it is another down day for Asian equities, which did pull back then unfortunately this morning as heightened concerns about the coronavirus infections and the timing then of a vaccine weren't enough, unfortunately, then, and were outweighed by the lift from upbeat corporate earnings in Europe. Stock markets have, however, rebounded significantly in quite some time now, sharply, particularly over the weeks that have gone past, as the spread of the novel coronavirus has slowed in some countries, particularly in Asia, even in Europe at a time like this as well. Then parts of the US economy did begin to reopen as well. That has been quite significant. However, in company news, and for video gamers in particular, right, during the coronavirus lockdown, a whole lot of gamers have certainly played their part in the market, and revenue, first quarter revenue, that a Chinese gaming and social media giant Tencent Holdings picked up by 26%. It actually beat forecasts, right? So these are the type of companies that are clearly crisis-proof or coronavirus-proof, more likely than anything, because people continue to stay at home, and we're seeing that continue to play into the market. The world's largest gaming firm by revenue did say on Wednesday that its profits for the 3 months through March was $4 billion, so a good number there. Over in Europe, though, unfortunately, the growth numbers for a whole lot of economies around the world, including those in Europe, are bound to suffer. Britain came out with their growth number today, that economy shrinking by 5.8% in the month of March alone. But the 3-month figure, that's for the first quarter between January and March, that economy contracting by 2% then, of course, from the last 3 months of 2019. It's the biggest drop since the depths of the financial crisis in 2008. We're bound to see that happen across the board and in many areas and many sectors across the globe as well. Then they aren't the only ones that are going to be suffering that growth figure. Just a quick check-in on that Brent crude price, still below $30 a barrel, but the gold price also $1,706 a fine ounce. It's $18.35 though for a US dollar, and that's a slight better trading figure for the local currency then against those numbers. Let's unpack this market picture though and chat to Michael Treherne, who's portfolio manager at Vestact Asset Management. Michael, thank you so much for the time. Appreciate it this afternoon as well. It's a bit of a mixed bag really when one takes a look at how the market itself has traded. I guess it's all about weighing up the fears of opening up economies too early with the sense of, yeah, if you open up, we do get some economic action going along. So certainly a big balancing act now.
Yeah, for sure. So markets, at least for the next month or so, will be very driven by how quickly global economies can reopen, how quickly we can see trade numbers increase again, and more importantly, how quickly we'll see consumers return back to spending. Yesterday there was a bit of a wobble with global sentiment. Anthony Fauci, the US head of disease, was saying that warning against opening too quickly on the back of him saying that if global economies open too quickly, there's a risk of a second wave that could be as bad as the first wave. So that word of caution the market wasn't too happy about. But if you have a look at markets throughout today, things have started to pick up again. So sentiment is looking good. And economies are sort of taking the view that, we sort of know what we're dealing with now, and there's some treatments that seem to be slightly effective. And at least we've got some idea of how to deal with COVID-19.
Yeah, and then you've got companies who certainly know how to deal with COVID-19, and it's just because their business has really geared up for it in many ways. The likes of Tencent, revenue there going up 26%, $4 billion in the first 3 months of the year. That's a good number for them. It's a good company there.
Yeah, very much so. People were slightly worried about Tencent coming into the year, but the share is now back at almost all-time high levels. And thanks to the weak rand, Naspers and Prosus, who own are the 1/3 owners of Tencent, those stock prices are up 5% this morning on a very good set of numbers coming out of China. And the reason is people are stuck at home, or were stuck at home, meaning that you spend more time on your mobile devices, spending more time chatting to each other. And in Tencent's case, you spend more time gaming, which is good news. The one area that they did struggle is they've got WePay, and obviously with people being stuck at home, they didn't use their payments as much as they did previously. But Tencent saying that that's a temporary thing and things are looking like they're returning back to normal. So, yeah, South African investors very, very fortunate to have exposure to Tencent.
Is it a time where we're still wondering just how much the impact of COVID-19 will be on companies before we're able to say they've kind of all bottomed out? It just feels like we've hit so many rock bottoms in the interim period that many stocks have fallen to levels where many people would consider them cheap. But are they cheap enough at these levels?
Yeah, I mean, global markets over the last 2 or 3 weeks have been trending higher. The market low for most markets was the 23rd of March. And that was just before most countries went into lockdown, and was sort of sell first, ask question later. There's no doubt that we don't know exactly what's going to happen. The market is pricing in a fairly swift recovery, I mean, what you would call a V-shaped recovery or U-shaped recovery. Market saying by the end of the year, more than likely, life should mostly be returned back to normal. And in the interim, government stimulus is what will prop up most of the economy. So that's sort of the market view at the moment. And as that changes, you'll see share prices reflect that. If we're in for a very long-term lockdown, no doubt share prices drop further. If we see or find a cure before then, you'll see share prices spike very quickly. So it's all about markets trying to predict what's going to happen, and that creates volatility. And when there's volatility, there's opportunities to make money.
That opportunity to make money, though, comes in a time when I suppose investors are fearful of what to get into, right? And the sectors that they need to perhaps look at as well. But playing into that is also the local currency. We say strengthening at 1835 when it actually started the year at 14 Rand odd, but certainly a good twist to that number.
Yeah, I mean, if you have to look at our local economy, it's probably not a bad thing that we've got a weak rand. Our biggest import is oil, and oil has completely collapsed. So we don't see that inflation impact coming through. No one's going on international holidays anytime soon, so that's off the cards. The next biggest thing that we import is electronic devices. So if you can hold off buying a new laptop or a new TV for a while, the economy will actually do quite well. We will be more competitive on, on clothing manufacturing, and our export division will do really, really well with the weak rand. So if we're looking for silver linings, the weak rand is actually probably a good thing at the moment, given that we're not seeing inflation come through from the weak rand, which is normally the problem. And let's hope that our Reserve Bank can cut interest rates further to assist consumers and businesses alike.
Do you see another interest rate cut, and by how much?
Yeah, markets seem to be pricing in about another 25 basis point to 50 basis point cut. If you have a look at our interest rates compared to the rest of the world, we're still on the high end. So I would definitely say as long as inflation stays under control and oil stays low, I do see potential for more interest rate cuts.
$30 a barrel then for that oil price. Michael, surely something's got to give here. You've had stockpiles in the United States now, unfortunately at higher levels than expected. Saudi Arabia, though, yesterday had said that they're going to reduce supply even more, but still, market still not budging. Why?
Yeah, the problem is that in March and April there was a 30% oversupply in each of those respective months. All that extra supply still needs to be used up before you'll start seeing the oil price moving. At the moment, it still looks like you've got oversupply of about 10% of general market. So there's definitely more supply than there is demand, and prices won't move until that is properly balanced. And, for us down south in South Africa, a low oil price is a good thing. It's probably not as good for some of our African neighbors, but, as a consumer of oil, I can't complain with the low oil price.
Fantastic. All right. Well, Michael, appreciate the time. Thank you so much for chatting to us here on SABC News On Point, of course, as we unpack that market picture. He is from Vestact.